we will also be taking questions from the audience.
Sure.
But before we do, there was a poll I did with the audience stating pretty much like how much macroeconomics or do investors actually need? And then the options were it's very important for most of them. It's only important for a select few, or it's like a little bit middle of the road.
Sure.
So what would be your opinion on that?
Sorry.
The result was mostly positive for that. Hey, you should know macroeconomics, and then quite a few people also voted for it depends on what type of investor you are.
Yeah. So to that point, I would say I agree to that in the sense that if you subscribe, let's say you're a fully technical analysis based investor, I don't necessarily subscribe to that or believe in that approach, but there are schools of investing, you can call them, that pay no attention to that stuff. I'm not saying all technical is like that, but there are certainly some schools. My own view as a fundamental investor anyway, someone who buys...
technical investing is basically looking at the chart, right? And searching for patterns.
Yeah, so very quick summary of technical analysis. Technical analysis is the belief that the price of a stock reflects all the information you need about that company. It's sort of a quasi-efficient market kind of basis in the sense that, if a company's trading at this level, it's because that's what the market has deemed it worth. So therefore, the only price data point we need is the price of that stock. The problem with that is that there's not a whole lot of research that supports the notion that technical analysis actually helps you. And a lot of the time, it's just people trying to superimpose patterns onto historical data sets. And, you can see there's a joke that, if you take 10 technical analysts, they'll point out 10 different price patterns for the same stock chart.
Yeah.
So it's kind of I don't want to say there's no merit in it, because there are technical indicators I think are helpful to have an eye on, because they can tell you if the market is, aggressively buying a stock or selling a stock. And there are insights provided by that. But it's to say that someone who focuses solely on that, it's really limiting your insight into the companies you buy. And there are certainly approaches that try to, a lot of online courses will talk about technical analysis because it's the easiest to convince people. And there's a lot of snake oil in that space. So it's a very tricky landscape to navigate, but regardless, so that's technical analysis.
Yeah, but before we move to fundamental analysis, there's one thing that you said that surprised me a little bit, in the sense that you said like this comes a little bit from an efficient market perspective. But I always figured that technical analysis is sort of anti-efficient market, because if you assume the price is right now, then there's no reason to expect a pattern.
Yeah, and that's why it's kind of quasi for it, in the sense that some aspects argue for it, some argue against it. It argues for it in the sense that the technical analyst, in terms of pure technical analyst, doesn't believe that you will get any helpful information from researching the underlying company.
Right, okay.
That all that information will be reflected. What they instead believe is that the prices of stocks will follow trends, and that it's more so buyer and seller behavior that matters. So that's kind of the distinction there. I think a true subscriber to efficient market hypothesis would believe that trends don't necessarily exist either.
Yeah, there shouldn't be a trend, because that should already be reflected in the price.
Exactly. So that's where they differentiate is kind of the... Now there is actually, funny enough, I was talking to Ben Felix, who another Canadian finance YouTuber, and he was talking about how there's a famous 5-factor Femme French model, which is kind of the passive investors, or one of the more passive approaches to analyzing stocks.
Yeah, and they look at what 5 factors again? Do you remember?
You know what? I never know them off the top of my head.
But one or two, like small caps or something like that, right?
Small cap value in the sense of the company's price to its book value. It's basically 5 factors that try to explain why a company is trading at the price it is. So there is value in kind of understanding those factors. And recently they released a new iteration with the 6th variable, which is momentum, which is kind of funny enough, that trend aspect of if a stock has done well in the past, is this kind of bleeding into the future performance. And I think he said something along the lines of the guy who added this reluctantly added it to the model because it sort of went against the theory behind efficient market.
Because that's pure behavioral finance. Momentum is behavioral finance kind of
and that's where the
factor.
two... And I would say, actually, funny enough, even though I believe in behavioral finance and not inherently pure technical analysis, that's another area where the two might differentiate. Is efficient market kind of explains things through risk variables. People who don't believe, or anomalies can arise because of behavioral variables. So it's just, how do you explain what you see in the market? You can explain it from a risk perspective, or you can explain it from a behavioral perspective of, people are doing it because the there are risk takers who are willing to take that and therefore they get rewarded. And then there's behavioral who say, no, this just happens because people are not good at at investing or become overconfident or whatever have you. So yeah, I'm actually seeing the comment now. Someone shared the factors. Thank you for sharing them.
Awesome.
So I think it shows my hand. I don't use the 5-factor model
Yeah,
in my job.
yeah.
But I have, it's a quite popular model.
It's
in
a
the world of
finance 101 thing, right? So we're
It
going to
is,
get
yeah.
to economics, but if you want to learn finance, definitely learn about the 5-factor model, learn about technical analysis, which is following charts, and then momentum, which means if the stock goes up, it will continue to go up. If it goes down, it will continue to go down.
Yeah.
But you're a fundamental investor.
Yeah.
And what's that?
So fundamental investing, people love to point out Warren Buffett as like the face of that movement. But it's kind of just investing with the thought of, at the end of the day, you're just buying a business. So the analogy I like to put is if you were to buy a convenience store or gas station, what would you as an everyday person look to understand before you made that decision? You probably wouldn't care. Maybe you would, but you wouldn't put as much merit into what it traded for in the past. You'd probably care a lot more about, how much money do they make? Who are their suppliers? Does their employee base cost? That's fundamental analysis, is just trying to understand a business and seeing whether you want to own it as a investor. So it's on the one hand, it's a lot more qualitative than a lot of other like quantitative investing, which is sort of a third school of thought, and actually what Patrick Boyle would himself describe himself as, focuses on backing out relationships using data analysis of quantitative variables. So basically, kind of just doing a bunch of regressions, if you will, and seeing where are the correlations and can we use this to exploit and make a profit from trading.
Yeah. And these are fundamental variables then, or it doesn't matter?
I don't think it matters. True quantitative analysis probably will look at anything, including even technical variables. Really, it just focuses on taking quantitative factors that you can analyze and regress and seeing what relationships exist and what's statistically significant and whether that can be used on a forward-looking basis to trade or invest. And I think there's a lot of interesting work that's done there. And actually, with a conversation with Patrick himself, one thing he pointed out is that in doing that, you see that there's never a consistent relationship that investors can exploit.
Yeah.
So it's not like you do a quantitative analysis and find the golden formula that, sets you for life, that you just find this one piece, then you can go sit on a beachfront and have this, robot trade for you. It's constantly changing. The markets are constantly changing. The relationships between these variables, because partly to your point, macroeconomic factors greatly change the situation and how different variables might interact with one another.
Yeah.
A low interest rate environment versus a high interest rate environment might actually change how different variables react and what investors reward or what investors punish, if you will, from public stocks.
Yeah. Yeah. So, and if you're a quantitative investor, right, then you're running an algorithm typically, or you might also do that. And it might you might be in 2007 and you've back tested 10 years and the best thing to do is actually invest in houses. But then it crashes completely. Well, then maybe you could have seen momentum, but when then the central bank intervenes, your backtested algorithm could never have spotted that, no matter how good your data was, because that never happened before.
Yeah, and that's kind of a point to keep in mind, is especially on the long term, and I think a lot of quantitative investors would agree to this, is that similar to not finding a golden formula, you probably won't find something that shows you a long-term relationship that you can rely on. Because a lot of outside the fact that there's just more data to support shorter term relationships, if you will, it's just, I think, people aren't blind to the shortcomings of their own approach. Just like as a fundamental investor, I'm well aware of the shortcomings of that school of thought. But for quantitative investors, I think a lot of the time it's more short term focused, as opposed to, say, buying and holding positions for 5 years. I'm not a quantitative investor myself, strictly speaking. I would assume that's unlikely to see buy and hold strategies in that realm.
Yeah, but you are a qualitative, fundamental investor. And so you look at the fundamentals of company, look at their price and see if the two match up, roughly speaking.
Yeah, so I say there is, a quantitative aspect to it. You do obviously look at their finances, but it's more so qualitative in the sense of, really understanding the variables that impact the business and whether you think those variables will continue, whether you think they'll improve or deteriorate. So there are judgment calls that come with fundamental analysis. But I think at the end of the day, what draws me to that function is it just makes a lot of intuitive or logical sense, because you can it's more tangible than the other two, I would say, in the sense that, again, if you look at investing, which is what it is of buying a business, technical analysis looks at buying stocks as price tickers. Quantitative analysis kind of looks at it as a bunch of variables that will determine whether you make money or not. Fundamental analysis looks at buying an underlying business and whether you think it will do well over time or not. So there are qualitative features to it, certainly subjective calls, kind of similar. I can't be all that rude towards technical analysis because you could probably get 10 fundamental analysts in a room and they'd probably say roughly 10 different things about the same company because a lot of it is subjective. But one approach that I've kind of learned from my company is it's really focusing on companies that you like the return potential, but also capping the amount of risk you're willing to take. And that risk can be on the side of debt, as opposed to buying a bankrupt company or a company that's very close to bankruptcy.
Mm-hmm.
And it's not to say that there's certainly approaches that would actually focus on bankruptcies and stuff because there is a large return potential, but that's where you get to more lottery like positions where it's kind of a
distressed debt markets and all of that stuff.
Yeah, heads it makes you a big return, tails you lose everything. So we try to avoid those situations. Yeah, we do a bit of diversification, nothing too crazy, but as opposed to just buying 5 or 10 positions, which is kind of what Warren Buffett and Manish Pabrai and a lot of famous investors advocate for. We might hold a bit more than that, but it's really just that core belief of investing in businesses that you like, that you think the finances look good, and importantly, that the valuation makes sense because how much you pay for a stock is just as important as whether the stock is actually a good company.
Yeah.
Because if you have an exceptional business, but you pay an above exceptional price, you could actually still lose money on that same position.